Hi, I'm Mel Lopez, Chief Economist for ASEAN.
And I'm Peter Lundgreen, founding CEO at Lundgreen's Capital.
Welcome to Sound Economies with Mel and Peter, an East Meets West podcast by Lundgreen's Investor Insights. Here we share what we're focusing at in economies and financial markets from the developed and the developing world. Hi, Peter. How are you doing? I hear you have amazing news to share with us today.
I'm doing really good. It's a party time here. Yesterday we got then officially that we got a prize for our China Mutual Investment Fund from the very prestigious award from LIBOR.
Mhm.
And it's basically they're looking at the 5-year return in the fund, and that is actually we're beating all the others. So it's the best you can get in the market right now up here in the Nordic area. So we are celebrating. We're happy. We will return a bit to that one. Have a conversation about what is in it. But anyway, how are you doing, man?
It's also been a great time here, Peter. In Manila, our team is preparing for an upcoming webinar that we are also hosting. That will be next week, May 6th, 3:15 p.m. CET, or that's 9:15 p.m. in Hong Kong time and 9:15 a.m. in US time. It will also focus on the China Fund, our decorated Lundgreen's Invest China Fund, and the way forward in terms of the Chinese stock market. Actually, that's one of the topics that we have on the table today, Peter. So a bit of
Yeah.
a lengthy discussion, but very engaging, I assume. Today we'll discuss how we manage Chinese stocks and a bit of a look ahead on what's next for the stock market. We also look into Southeast Asia and briefly talk about the rise of digital nomad visas that's becoming the new thing in terms of tourism campaigns. And then we look to the US and look at the progress or lack thereof of tariff negotiations with trading partners, as well as shifts in international shipping and trade, which we see as a visual proof of the very hurtful trade conflict that's happening across the globe. And as usual, we would wrap it up with our global outlook. Peter, let me get started on asking you about, of course, how we got into this lip reward and what makes a good strategy in terms of managing a Chinese stock portfolio.
Yeah, the last question is always the good question. Yeah, that's the golden question, minimum $1 million question. Anyway, maybe we should explain that the LIBOR Award is it's handed out every year,
Mhm.
and LIBOR is owned by the London Stock Exchange. LIBOR is in the market assessing results from asset managers, the funds since 30 years, and it might be maybe the most experienced company in the world doing so. And what
Right.
they do is they do not only look at sort of the absolute return, they also look at what we would call sort of risk-adjusted returns, meaning how much risk have we taken to obtain a certain result. And so they simply measure on a lot of funds, and here in the Nordic area where we belong. So to say, it's the official place where we offer the fund. That is also the market where we get measured, but that includes all the global asset managers, international asset managers that offers their funds, China funds in the Nordic area, and that means that is so it's not only local asset managers offering a China fund. It is also in competition with all the big names that we know from as the very big the biggest names, and there our fund for the 2025 award has won for the 5-year track, and it is actually very prestigious. People are very happy on our behalf, and we are after all a small house, but it shows that quality is something different than size, and that is basically what we aim at. but maybe so to actually to take it as sort of the reason to talk a bit about the Chinese stock market, but also how do we manage? I cannot tell about how other funds are getting managed, but we do have a couple of approaches that are different. Is no secret. Officially, I'm actually the portfolio manager, and Lundgreen's Capital is of course doing the advisory of the fund. At Lundgreen's, we run a China conviction model that includes a lot of factors that we consider as important when we
Mhm.
look into sort of the overall China development, particularly, of course, how the Chinese economy and stock market is moving. Yeah. Now, that is what you classical would call a top-down approach. That ends up in some preferred sectors within the economy, where we would say these sectors should be maybe for 100% or at least for majority represented in the portfolio in the fund. And then we have a very strong, very long-standing relationship with a partner in Hong Kong for this kind of advisory. They work under the name GG Capital. They are affiliated with Skybound Capital, an asset manager of 150 people represented in actually UK and also in South Africa and Australia and Hong Kong. There's the chief investment officer, Theodore, is a long-lasting friend of mine, and we completely trust each other.
Yes.
And his team is actually doing the proposals when it comes to the actual stock pick and stock selection, and saying these are the proposed companies to invest into, and then the final decision is taken. And the reason why we have this sort of a two-pillar system or two-team approach, whatever, is the local representation in or close to China. Even big companies in China, as what we would consider as big companies, they might be sort of mid-sized in China, but really big in many respects. They might only offer their balance sheets and reporting in Mandarin. So there's very basically a linguistic issue to understand the
Mhm.
company. You need to be a Mandarin speaker. Also to visit the companies on investor conferences, so it is much easier to be handled from Hong Kong. So there's a lot of good reasons why we actually have this long-lasting cooperation. And it should be mentioned that the fund was incepted in August 2019, and we have not changed our trading strategy or investment strategy since then. It's just the same. So what we do is we are of course obliged to be in Chinese stocks because that is by law. We need to be in the asset class that we say
Yes.
the fund is investing into. We solely so far invest in China stocks that are listed outside China, typical
Mhm.
Hong Kong or, or US. So we have dollar-related assets, and the fund is run in euro, so we have a currency risk. We do not hedge that one. So there is a currency swing as well. Investors should be aware of. This is very similar to what others are doing, but where we are trying to say, okay, the way we adjust the absolute risk level in the fund is actually we consider cash as an asset class as well. So we
Mhm.
do use cash in the fund to say, okay, our cash level is actually one of the instruments we use to say the absolute risk level is getting higher or lower. So we do run with a typical a certain cash portfolio or cash level to adjust the risk. Further, we take a part of the portfolio as the investments we do are typical long term, sort of mid
Mhm.
to long term, but around 15 to 20% of our portfolio we run in what I call a Chinese style. And that means that we are much more active on these 15 to 20% of the total portfolio in the
Mhm.
market. The Chinese market is well known for being very volatile, and it is more volatile than, in particular, the European market. So we are trading, so to say, or moving a bit up in and out of these 15 to 20% of the portfolio on a more frequent basis. So maybe within the week or within 2 weeks, or it can be within the day, as we are looking more for the move.
Yes.
uh, Sort of whatever happened, whatever could happen in the stocks. So there we are looking for sort of short-term moves, and that is very typical what is happening in China. So investors, they run for also the short-term trend. They're extremely momentum driven. So this we actually try to replicate, and this is also why we have a local cooperation partner to get that how to say it, to get that part better in the portfolio. So this is how we run the fund. We do not have that many stocks in the portfolio, like I think today 45
Mm-hmm.
different companies we have in the portfolio. And there we actually, yeah, as mentioned, we have a cash part. We do have a part that is more short term and just market driven optimization. And this is what we have been doing for more than, yeah, it's now 5.5 years. Yeah. And honestly, yes, we should imagine the wild markets that the fund has been through. Incepted in August 2019, and in January 2020, the
Yes.
COVID crisis hit China. And then we had the first roller coaster dive. My God, yeah. And then we actually had another roller coaster season when COVID 19 hit Europe and US. Yeah. And after that, we had enormous rises and enormous steep falls. The fund has outperformed in under all sort of market conditions. Uh, Steep drops, extreme bull markets, also more quiet periods. And then we've been through a period of 3 years where basically every day was negative. It was almost a loss every day. Yeah. It is not what create a smile on your face, yeah, uh, because you need to deal with this negative market every day. But we've been through it, and apparently done a good job. So we're very proud. Been a big thing for a small company, but the most important is, of course, that there's some outsiders looking into what we're doing and say this is thumbs up, and we are very grateful to the investors in the fund who have trusted and basically believed in us and supported by being investors. So thank you so much for that. In that sense, it should be mentioned the fund is open every day. People can enter
Yes.
every day. It's listed in Nasdaq stock exchange in Copenhagen. So it's simply a listed mutual fund. There is no sort of, it's not private equity. So it is a listed mutual fund. So that is a bit about what we're doing, how we do it. The Chinese market, how we try to work around the Chinese market that is very, very different from what we normally see. Yeah.
Mm-hmm.
Uh, and what do we expect to the Chinese market? Yeah, that is actually what our webinar next week is all about. We
Right.
can disclose if people are looking at it. We do say it in the headline. The way we think here in our house about any market is very often when you challenge ourselves. So, what is the next move? Is it is not if it's up or down, but where are the next 10% or where are the next 25%? Are these up or are these down? And we actually say that in the Chinese stock market, the trend, the next 25% is up. And
Yes.
it's a you could say it's a wild time to in the middle of the war with Trump to be on the play field and say this is going up, but it's actually we think and we argue why, and that's basically what it's all about next week in the webinar. It's not There's a small introduction to the fund, but this is not a sales approach in that sense that people should listen endless to the fund as such. We're looking into the market, we're looking into some of the stocks in the fund and what we're thinking. So yeah, so it's quite exciting. Yeah, so that's probably yeah
I
why we are
agree.
partying here. It's so good in the company, and Mel, you're a part of it as well. Yeah, so
Yes.
this is so great. Yeah.
If
So
anything, Peter, the roller coaster events of the past 5 years and ending up in a plus 25% scenario still for our China fund, it is encouraging, and it fortifies our long held view that the Chinese market is still has a lot of room to grow, and that's what we're seeing with the Lipper Award and with what we see ahead. Although we'll have more of that discussion next Wednesday, and we hope our listeners will also be there. That is happening next Wednesday, the 7th of May at 3:15 CET in the afternoon.
exactly.
So it's
Yes.
an exciting time, Peter. Speaking of a high growth area, uh, go back to China in just a bit, but we'll look into neighboring Southeast Asia. So
Mm,
here in the Philippines, Peter, we are joining a list of countries that is embracing the digital nomad era. So a digital nomad is a foreign national who is uh, holding a fully remote job, and they're looking for a place to stay long term. It's like the best of both worlds. You get to travel while still earning and making a career progression of some sorts. So
mm,
I see this as a trend across Southeast Asia right now. So the Philippines signed an order about a week ago allowing it to happen. So the country is about to issue 1 year visas to these digital nomads. And this is already an existing system for Thailand, Malaysia, and Indonesia. So areas
mm.
like Bali are popular for that, or the
Yeah.
developed islands. So we have here like Boracay, Siargao.
Oh yeah.
These are very popular, especially to like the Americans or the European tourists. I
Mm,
think this is a move towards um, being selective towards tourism, attracting tourists. So you don't
mm.
want to get beg packers, as we call it here, right? Like the
No.
people who are literally begging the streets for money so that they can keep navigating Asia. You want
Yeah.
professionals who earn money because they
Yeah.
are the guys that will provide you with tourism revenues and help the economy grow. So Vietnam is also moving towards that direction.
Mm,
And yeah, I think this is also a good indicator of, or a good way to build up tourism as a source of economic growth at a time when global trade is under
mm,
threat. Just to contextualize it, um, the share of tourism to GDP in the Philippines is at 18%, 15% for Malaysia. The ASEAN
mm.
average is around 12%. In comparison to the US, it's just at 3%. For EU, it's 4.5%. So there's really
Yeah.
a big room to expand it further and make
Mm,
it uh, a more viable contributor to growth at a time when global trade is slowing down. And I
mm,
guess it's also a testament to high cost of living issues elsewhere in the developed
mm,
world. Because if you have a digital nomad earning in, say, a USD or euros,
mm.
and you get to spend it here in Asia, you're quite a winner there. And also the local
Oh yeah.
economies will benefit from that too.
Sure, sure. So yeah, as I agree, it is actually quite interesting, and as we discussed, Mel, another, how to say it, another move towards attract, I should say, let's call it a bit more high end, or a bit more
Mhm.
higher paying kind of visitors. Is maybe not as a classical tourist, but attracting foreigners
Mhm.
in different ways. Yeah, as a tourist, or people looking for being settled in half a year or 2 years, whatever, yeah, and spending the money.
Yes.
And that's interesting. That is, of course, also we notice that when we are considering which segments are worth to look at, yeah, from an
Mhm.
investor's perspective. Yeah, another step in that direction, attracting people and the right people.
Right.
So
We look
good.
over now, Peter, to, of course, the US. As much as we've talked about it over the past months or weeks, it still remains to be the biggest source of, I guess, jitters in the markets
Yeah.
globally. And what we observed over the last week, there has been little progress made in terms of negotiating the tariffs, the very high tariffs that the US set against
mm,
its all of its trading partners, even long-standing allies. And
mm,
the most recent opportunity that would have been a perfect venue to make these deals was the World Bank IMF spring meetings held just last week in Washington, D.C. So finance
yeah,
ministers from all over the world were there to
mm,
attend the meetings. And if they wanted to, they could have easily set up negotiation meetings with Trump, with his cabinet, with the Treasury Secretary, but it really didn't progress. They earlier
no,
said that they had 18 proposals, written proposals, waiting to be addressed. But it seems that the US isn't also ready to with their asks as far as the negotiations are concerned. So if anything, this shows that they were very abrupt in slapping these very high tariffs, but they're also not as prepared, which is why the 90-day pause is
mm,
necessary, not just because of the partners want it, but apparently the US is also not ready with their what they want to get out of every country that they impose these tariffs on. And as the
mm,
days go by, we know that there is a 90-day wait. The less progress you make in terms of um coming to a more reasonable rate for imports, it
mm,
does add to the already highly uncertain market that everyone is navigating, and it's not boding well for the markets every day that passes. And if you consume the 90 days, right, that would even be more scary or disastrous. And people are waiting, people are scared, and we see
mm.
that in the market still.
Yeah, sort of where we are is sort of the discussion of postponed risk, so to say. If people do not really find solutions within the next 2 months, because that's what we're talking about, yeah,
Yeah.
then the postponed tariff will then come into effect. Maybe that is one that's one outlook, so to say. Of course, Trump is softening up on different details all the time. So he's trying. He's actually trying to repair the where it hurts the most on the big companies in US. Yeah, that's very obvious. I won't call it a disappointment, but the gathering, the IMF gathering
Mm-hmm.
last week, as you say, each and everybody was there, or almost. At least there were enough high caliber
Yes.
finance ministers and alike represented it to to do something.
Mm-hmm.
Basically, they didn't do anything because the alternative would have been that they had done something a bit more bilateral, more sort of trying to work around US
Correct.
as a, let's say, what we had talked about the past 2 months in particular, 3 months, the world against US as a finding solutions so the rest of the world actually say, okay, US is a problem, but we find partially solutions together outside as away from US. Yeah,
They're moving on from the US,
yeah, yeah.
basically.
And but that didn't materialize either. As a and that's a bit more sort of sad because it could have been fantastic also signals to US or to Trump basically that people are finding each other in a different way. Yeah. That would have been good. It would have been good for the stock markets globally, and it would have been good for I think the self confidence around the world. Yeah. So but anyway, but yeah. So the uncertainty is there, and it's a bit on a high level. Yeah.
China has
That's it.
done like that, Peter, though. Like, one of them is clearly lying, but Trump's claimed last week that President Xi Jinping has called him up about the tariffs. And then here comes Beijing denying it, that it never
Yeah.
happened. And what they did instead was to open a new shipping trading route to Peru between coming from Guangzhou in the south of China to
Mhm.
open up greater more trade volumes towards the Latin American region. So I think if anything, that is another sign that at least China is trying to move past these hefty tariffs by just looking elsewhere and then, oh, where else can I send my goods? And
Yeah.
maybe that's the ideal response from a country that is really trying to compete against the US.
Certainly, yeah, and that is an interesting move. And if we sort of take the last on the piece we have on the table for today, and that is actually what happens in the shipping traffic across the Pacific Ocean. Now, the number of container ships arriving from China on the U.S. West Coast is now declining, and it is so easy to see now that within the next week or so, there are ports who are seeing maybe 30 to 40% decline in the number of container ships arriving from China. So U.S. companies has now really stopped ordering as much as they used to purchase in China. We are also in China, we are actually observing that
Mm-hmm.
these particular industrial sectors, they are suffering. And there are some areas sort of where they are situated in China. They are trying to scramble to see if they can, what they can do to compensate. Yeah? This is happening, and it means that in the coming weeks, as we're looking into, a significant lower number of ships will arrive on the U.S. West Coast, also from China. It is all the way, and it's outspoken in Seattle, but also even LA, we are talking about around 35% of a drop in arrival ships. So that is it's significant. What we sort of are looking into is who will get hurt. We all know the story about all the shoes from Vietnam. How that Vietnam is truly hurt by the shoe export to US. Yes, but if we look into US, what we already have seen is that very small companies, as when we talk about one-man shops or maybe 5 or 10 employees, who really depend a lot on import from China, they
Mm-hmm.
are already now completely sort of underwater because they are paying so much in so the tariffs have gone extremely up. Yeah. There we see this could very much be, in particular, this segment of the business segment that has stopped ordering from China. If that is the case, we will see thousands and thousands of these companies. They will simply close down, and that will be a wave that will go across US, and that will be the first price to pay in the US economy. That all truckloads of these small companies simply go bankrupt or close. That has already hit the news, but when it happens in a big scale,
It
if it happens, then it will really go on the front page, yeah, and that will be painful. Otherwise, as what we are looking into as well is that on if we look into the statistics and particular sort of maybe sort of some of the first indicators from the shipping industry is that
Mhm.
some ships might be redirected. And the interesting thing is if the traditional importers, US importers of Chinese goods, already now are trying to find other sources around in Southeast Asia where they can
Yeah.
buy the stuff. Now
Mhm.
that is interesting, uh, and it could actually be one of these sort of market-driven solutions to
Mhm.
compensate for the tariff war between U.S. and China. Now we simply don't know, but we are observant towards these issues we talk about here, and that will be very interesting, actually.
That could
So
take some
yeah,
time either, though, because if you want
yeah,
to produce exactly the same items that China
yeah,
used to supply to the US. Of course,
yeah.
the technology, the manufacturing processes need to be transferred directly or at least indirectly just so you churn out the exact same thing, which is would be hard, especially if you're not a manufacturing powerhouse as big as China.
Yeah. So it is. Yeah. It is. It's not that easy. But let's see. It's interesting to see if things happens in that direction. Yeah. Anyway. Yeah. So how's the global sunshine? I mean, tell me.
Yeah. Well, as we have seen in the past few weeks, there are more clouds in the horizon. There is little sign that it's clearing up just yet because everything's on hold as they wait and see what Trump will do with the tariffs, which ones will go down, will it go down, especially particularly towards China. But we are seeing more and more signals that domestic economies in Asia, particularly, are finding new ways to support growth, as we've discussed with how China is pivoting its to Latin America, for example, or Southeast Asian economies banking on a new revenue stream through foreign tourists. So these little, seemingly little ways to find or support growth in a different sector or a different market supports further growth in this region, Peter.
No news from our house that we simply consider Asia as so strong. It's the biggest economic region in the world, yes, but there's so much, how to say it, regional internal strengths
Mhm.
that it can compensate for a lot. And in general, there's still wait and see. US can hurt the global economy. Yes, they can. They're a big player. They're the biggest economy in the world.
Mhm.
All the stuff is taken into account. But if the world really was weak, we would have seen stock markets crashing, and we would have seen a much more severe situation. So we consider to say the world has a good strength,
Mhm.
can store a lot, also has a lot of headwind. So we still like risk. We have we have cut our U.S. risk, yeah,
Yes.
and so we like Asia as we normally do. We still like sort of being in the middle of the curve on fixed income. We like Asian credit risk, particular government risk. Yeah. So we are not afraid of the world. We actually see the upside. But there's no doubt the world doesn't run at a high level, yeah. But there are a lot of opportunities out there. So it's how we see the world.
Thank you, Peter, for sharing your insights today. And we hope to see our listeners tune in to our webinar on May 7th, our China Fund, What's Next After the 25% Uptrend. To know more details, please do check our website at lundgreensinvest.com. And thank you. See you there. We'll be monitoring global developments and we'll share what's interesting in the next episode of Sound Economies, Mel and Peter on the Global Financial Markets, a podcast by Lundgreen's Investor Insights. Thanks for tuning in. For expert insights on the go, download the Lundgreen's Investor Insights app for free. For investors, we offer very exciting and high quality alternative investment funds, including our top rated Mutual China Fund. To know more, visit lundgreenscapital.com.